Amini, the CEO of United Legacy, and welcome to episode 15 of Behind the Curtain. In this episode, we're going to be discussing some of the latest trends and updates in the financial world that have caught our attention. As we continue to monitor the latest developments, we'll take a deep dive into the current state of the global economy, including the Federal Reserve's recent decisions, the ongoing banking crisis, and the housing market. Will this be the Fed's final rate hike? Starting with the Federal Reserve. The U.S. Federal Reserve met again last week and raised the Fed's fund rate another 25 basis points for the ninth consecutive rate hike to fight inflation. In fact, at the Fed meeting, in the press conference, he kept talking about getting inflation to 2%. My beliefs are, and here at United Legacy, we believe we're now at a terminal rate of 4.75% to 5%, the highest mark since 2007. Every central bank increased rates this past month, while Chairman Powell stated more hikes may be necessary. He also stated that the case for rate pauses to see the lag effect of rate hikes, signaling we most likely have seen the last hike in this cycle. Though they would want to keep rates higher for longer, higher rates are currently causing the banking crisis. The CME FedWatch has almost 100% chance of no hikes in May meeting and a 72% chance of a 0.25% cut in the June meeting. The Federal Reserve actions will continue to have significance in 2023. The indexes have been holding up relatively well so far this year with the current banking crisis, but if history rhymes, once they start to cut rates later this year, there could be a 3 to 6 month window where the markets can become extremely bearish as cutting rates and QE are not bullish. Over time, they usually are as more money flows into our system, but not right away. This can be seen right now as money markets funds have hit an all-time high, $5.1 trillion, as investors are bracing for impact. Moving on to the current state of the banking crisis that we've been watching diligently. During the past week, world leaders attempted to send a coordinated message. I'm not sure if you guys watched it in the media, but President Biden stated that, quote, our banking system is safe, while U.S. Treasury Secretary Yellen described the U.S. banking system as sound. Meanwhile, Fed Chairman Powell deemed the banking system strong, and the Swiss National Bank asserted that the problems of the U.S. banks do not pose a risk of contagion for Swiss financial markets. Additionally, ECB's Lagarde stated that they are equipped to provide liquidity to the financial system if needed, while the French economy minister claimed that, quote, U.S. bank failures pose no risk of contagion for European institutions. The Dutch Prime Minister Rutte also weighed in, saying that it is very unlikely we'll have a new banking crisis in the Eurozone. I mean, similar to the German chancellor expressed that, quote, the banking system in Europe is stable. However, despite these reassurances, Credit Suisse sold for pennies on the dollar, and approximately 200 banks, ladies and gentlemen, in the United States of America are facing the same risk as Silicon Valley Bank. Dutch banks credit default swaps hit a 4-year high, and they recently taped the Fed for $60 billion. It's important to remember that all of the same things were said in 2008 before things eventually got worse. Let's talk about Dutch Bank's liquidity problems. Now, Dutch Bank, which is a very important bank in Europe, and we just went through all the quotes that we heard last week from our world leaders, they're having financial problems, and they may not be able to pay their back debts. This could cause a big problem for the euro currency and other banks in Europe. Also, most of the banks in Germany are controlled by just a few big banks, which could be risky if one of them fails. The U.S. Federal Reserve has given a lot of money to a foreign country, probably Germany, to help with this problem. But if people lose confidence in Dutch Bank, they might take their money out and put it in another country where it's easier and safer. Interbank lending has stopped. Additionally, interbank lending has dried up, and the Fed has become the lender of last resort. Even for banks outside of the United States, the Fed started repo operations this past week. The last time this was used was during the COVID-19 pandemic and the 2008 financial crisis. This is usually the final warning before a crash, as it's self-fulfilling prophecy now. This confirms that interbank lending has indeed stopped, and we are on the verge of something bigger. The Federal Reserve's own policy of raising rates is causing all of these problems. They know it. The banks know it. And now you know it too. U.S. banks currently have unrealized losses amounting to $1.7 trillion, which are not yet reflected on their balance sheets. If these losses are realized due to a market downturn, banks could be forced to sell their holdings, resulting in significant losses and potentially triggering more bank runs. Furthermore, $7 trillion of the $17 trillion in the U.S. banking deposits are not insured by the FDIC. A recent study revealed that rising interest rates caused many banks' assets to lose 10% of their value this year. This, along with the accounting practice that allows banks to hold assets at their purchase price instead of their current market value, could cause a significant problem for the banking system. Two-year and 10-year Treasury dropping fast. Bond yields have finally started to move in the opposite direction. The 10-year Treasury yield has decreased from its highest point of 4.3% to below 3.3% as of this past week. Furthermore, the 2-year Treasury yield dropped significantly, going from 5% to 3.56% in just 2 weeks, marking the fastest decrease since 1987 Black Monday crash. Folks, this suggests that the tightening by the Federal Reserve is now complete. We spoke for weeks about how much the yield curve became inverted and what that actually meant. You heard it behind the curtain. This is the point that shows the economy is weak, but not necessarily when things are going to fall apart now. When the curve steepens to the point where the front end is going down, not long end going up, that is the time to pay attention. The 2-year yield is now rapidly approaching the 10-year yield, which is a red flag that should not be ignored. The bond market is usually ahead of the Federal Reserve as yields rose faster than they could hike rates over the past year. Now, it's telling us that rate cuts are right around the corner. Housing market median sales prices drop. Finally, let's turn our focus to the U.S. housing market. For the first time in 131 months, the median home sale price has dropped, a sign that the housing market as a whole is officially slowing. Home sales have ticked up according to the MBA, but mortgage applications are down. Mortgage applications tend to lead housing by 1 to 2 months, suggesting the uptick in home sales is unlikely to last long. In addition, in February, a new buyer of typical existing single-family homes had to allocate 51% of their disposable income towards their mortgage payments. This is down a few percent from COVID highs, but still significantly higher than the pre-COVID era when mortgage payments typically accounted for only 30 to 35% of someone's disposable income. Now, according to Redfin, to combat high payments, 1 of 3 new home purchases are all cash, hitting in the United States of America a 10-year high. So there you have it, the latest trends and updates in the financial world. While there are certainly some concerning developments, it's important to stay informed and be prepared for any potential changes. As always, thanks for tuning in, and God bless you.